No matter the type of annuity, whether it's variable, fixed, or equity indexed, most of them, or really I should say all of them, will operate within the topics you see on the board. I'll explain what I mean by that here. You'll see annuity statements, annuity contracts, labeled as both non-qualified or qualified. If something is labeled as qualified, that simply means it's some type of IRA, meaning that it could be a traditional IRA, could be a rollover IRA, could be a Roth IRA. Qualified money in general, whether you're talking about annuities or anything else, means it's some sort of IRA account. A non-qualified annuity contract just simply means it's not an IRA. These types of distinctions will become very important to you when you're figuring out game plans in terms of what to do with someone's annuity. But for now, just know qualified means it's a type of IRA, non-qualified means it's not an IRA. Now, when it comes to taxes on annuities, one of the most powerful things to know about annuities is you can take taxable money, non-qualified money in other words, place it in an annuity account, whether it's variable, fixed, or equity indexed, and you can tax shelter that money. You can tax defer it. So for example, if someone had $100,000 sitting in a money market account, or they had a CD that just matured, they're paying taxes every year on the interest they receive in that CD. If you take that $100,000 and put it into an annuity, again, we're assuming it's not an IRA, so that would be a non-qualified annuity. It's not an IRA. If you take that money, put it into a non-qualified annuity, the interest and earnings and gains that occur inside that account are tax sheltered. So if that $100,000 turns into $105,000, there's no taxes on it as it grows. The $100,000 could turn into $200,000, still no taxes. When you withdraw money from the IRA, all of a sudden that client calls you up, put in 100, has 105, they call you up and say, hey, send me that $5,000 of gain. Well, when they withdraw that money, that's when they're going to pay ordinary income tax on that gain. Capital gain taxes never come into play with annuities. Any gains that come out of an annuity, out of a non-qualified annuity, are always taxed as ordinary income. So the IRS gives you a break by allowing the earnings to grow tax deferred, but they don't give you the break of claiming it as a capital gain. Any gains received are taxed as ordinary income. It's also important to know that gains do not come out proportionally with the cost basis. All gains come out LIFO, last in, first out. So if someone puts their $100,000 in, it grows to $105,000, that $5,000 gain was last in. Therefore, when it's withdrawn, that gain comes out first out. Put in 100, turns into 105, that 5,000 comes out, it's fully taxed as ordinary income. Now, if that same person called you up and said, hey, send me $10,000, the 100 turned into 105, you take 10,000 out, the first 5,000, last in, first out, is taxed. The next 5,000 is dipping into their original money, dipping into their basis. That's their own money they put in. That amount is not taxed. So you're only taxed on the gain, and it's taxed last in, first out. That's how non-qualified earnings work and how non-qualified earnings are taxed. If you're working inside of an IRA account, a qualified account, then the taxation inside that product is the same as it would be in any other type of IRA, be it traditional or Roth. If you have a traditional IRA inside of an annuity, that's a qualified annuity, and traditional money when withdrawn is all taxed as ordinary income. Roth IRA money isn't taxed at all. So qualified taxation is just as if it would be in any other IRA product. Non-qualified taxation and growth is taxed like this. We'll get into more details about this down the road when I teach you how to sell and present these concepts to clients, but for now, I just want you to have a good understanding of the different taxation inside these different annuity products.